Welcome, everybody. This is Henry Lopez, and David Barnett is with me as well. He'll introduce himself here in a moment. Thanks for taking the time to join us this evening for this webinar on how to buy a small business. We're going to spend about an hour together, so obviously we can't cover all of the detail that you need to have to be ready to buy a business, but we hope to leave you with at least some key things to think about, some areas to go and learn some more about, and then we have a special offer at the end of the webinar for those who stay with us on some great additional learning and coaching opportunities. Both myself and David have had a lot of experience with small businesses. We've been fortunate to have businesses that we've bought and sold. And so I'll be sure to share some of my experiences as we go through the presentation. David's going to do the bulk of it, though, because this is what he's been specializing on here for quite a few years. So he'll do most of the presentation, and I'll add comments and experiences and stories from my personal experiences buying and selling small businesses. So for those who don't know me, again, I'm Henry Lopez. I'm a business owner myself. I've had the opportunity to own several businesses, just recently sold one of my businesses, and have bought and sold existing businesses before as well. I'm also a small business coach, so I help my clients with these types of things as well, anything from starting, running, and growing a small business. And as many of you hopefully have listened to, I'm the host of the How of Business podcast. Dave, if you'd introduce yourself, please.
Sure. Henry, I've always been a guy who's been interested in business. It's great for everyone to direct your attention to the slide on the screen because that's what I look like without a beard. I've always been involved in business, but about 10 years ago, it was 2008, when I actually got into helping people buy and sell businesses for the first time. And I started down the path of becoming a business broker. And I did that for many years. And in my local market, I helped people buy and sell over 35 businesses within a 3-year period. So I've got a lot of firsthand experience being the broker. And then subsequent to that, and I'll tell you just in a little snippet, business brokerage is a really awful business to be in, because it's all commission driven. So it can take years to convince a business owner that you're the guy to sell his business, and then it can take years to sell the business. And it was too erratic a cash flow for me, so I left the industry. But like, what is it? Is it Scarface, where they keep pulling him back in? So my phone just kept ringing. People were asking for my help because they were trying to do deals. And I started to offer my services to people in the form of a consultant. So instead of being a broker earning a commission, I was helping people much in the way an attorney or a CPA would help someone. They help you with a project and they give you a bill for what they did. And that's what began now almost 5 years ago for me. And it's now grown into a consulting business. And I also do the education piece, which grew out of the fact that people kept hiring me to repeat the same stuff over and over again. And so I learned, hey, you know what? If everyone wants to know the same bit of information, then maybe I can organize this into a course, and that way I can make it more affordable because it's cheaper for people to learn on their own than it is to spend the one-on-one time with me.
Absolutely. And you live up there where it's cold, right?
It's not cold yet. I'm on the east coast of Canada. So if you look at a map of the United States, on the side of Maine, there's a long straight border that is not the world's longest beach. That's where I live, right on the other side in New Brunswick. So we get to enjoy the 4 seasons, and the leaves are all yellow and red today. So
yeah, I'm sure it's
really nice.
Getting beautiful up there. And I'm in a suburb of Dallas, Texas. We're going to break this down into several components. Why do people sell their businesses? We're going to touch on that to get it started and open. We're going to talk about some of the distinct advantages and disadvantages of buying an existing business. And by the way, when we say buy an existing business, it could be a business or it could be a franchise location. And I've done both. So that term buying a business can apply to any of those types of businesses and existing businesses for sale. So we'll start to share with you what we look for, what David helps his clients look for, your criteria, the system that David has developed to help his clients educate themselves and walk through so they can make the right decision about buying a business, critical mistakes to avoid. We'll have a download on that as well. And then a special offer at the end of the presentation if you stay with us for an opportunity at a really good deal for some additional education and coaching to help you buy your first business. and then we'll open it up for Q&A. We'll go for about 60 minutes. We might go a little longer. Hopefully you'll indulge us with that, but we're going to try to stay on time. So let's get to it, David. Let's start with this topic of why people sell their business.
Yeah, sure. If you listen to popular media, you would get the impression that people sell a business because they have an opportunity to cash out some big windfall liquidity event, and those are the things that make the headlines and get into the popular culture. The reality is that small businesses are risky, and when you buy a small business, you're essentially purchasing a cash flow. Most people who buy a small business need an income. So they're looking to buy a business where they're going to become the manager and they're going to enjoy that cash flow. And because of the risk, people are not willing to pay a high amount for that cash flow. And so it very rarely makes sense for somebody to sell a really great business. If you have a really great business, you're lucky enough to own one, it makes sense to keep it and run it and to enjoy those profits year after year after year. So then why on earth would someone want to sell it? It comes down to personal reasons. So some personal reason is pushing the business owner to need to sell the business. It's not a want. And it's funny because when I had my business brokerage office, people used to come in to talk with me about selling their business. And I would ask them, why do you need to sell? And I phrased it that way specifically because as a business broker, I knew that small businesses sold for relatively low multiples of earnings. And I knew that the sellers wouldn't be terribly impressed with what I eventually would tell them would be the likely selling price for their business. So I needed to know that there was a real motivation there for me to undertake the effort to represent them and try to sell the business. And so the top reasons why people came in and said that they needed to sell their business were, number one, was divorce, burnout and fatigue and boredom was the number one reason, followed by divorce, poor health, the need to relocate, and retirement. Now, of all of those reasons, when I'm doing live sessions, I sometimes ask the group, who do you think is the least motivated? What surprises people the most is when I say it's the people who want to retire who are actually the least motivated. Because a lot of the times because they're planning a retirement, they're actually giving themselves a good lead time. They are thinking about what they're going to be doing over the next couple of years. At the bottom of the list there's another one, capitalization. And this is one that I often caution people on. Sometimes you'll run into someone who is trying to sell a business, and when you ask them, why do you want to sell? They'll say, well, there's great opportunities in this business, but I don't have the resources or money to be able to exploit those opportunities. And that's one that I'm always cautious of, because often when someone is using that kind of story, they're trying to convince you to pay more for the business because of some opportunity that may actually not be realized.
David, when I bought an existing business, a sweet salon business that I bought back in 2008, and I knew the owners a little bit beforehand and then have stayed in contact with them. And their reason was pretty simple in that they had been running it for about 10 years. And the primary owner, was just ready to move on to something else. He had actually bought and started this business rather after having sold another previous business. So he was done with it. I don't know that he was bored, but he was ready to move on to the next thing. And we owned it for 6 very profitable years, and then we sold it. So that was an example of the motivation there. A lot of times it's for entrepreneurs. I know I fall into that category. We can be ready to move on to the next challenge sometimes, and that's a reason to sell.
Yeah, and it sounds like that seller understood the situation he was in, because if you lose that passion and drive behind a business, what ends up happening is you stop doing the little things that make the magic happen.
That's right.
You stop returning calls. You stop, taking the time to make sure things are in proper order. Eventually, that loss of momentum in the owner's attitude will result in slippage in the business performance. And that's when things start to go into decline. So whenever I had someone come in to say that kind of thing, I'm looking for a new challenge, I would say, great, we need to get this on the market and sell it before that desire for something new turns into, sort of a complacency that's going to start to affect the business that you own.
Absolutely. But it also, where it comes into play though, is, and you'll touch on it, is that's where I can start to identify as a potential buyer those things that I can fix, right? But
Mhm.
let's start to get into advantages and disadvantages. There's a lot of them. We're not trying to cover them all here, but these are some of the things I think we often see as advantages of buying an existing business.
Yeah. Well, the biggest advantage to having an existing business is that you've already got cash flow. So there are customers that are already patronizing the business. There are employees that know how to serve them, and it's generating money. And, it gives you a huge advantage as a buyer, because if there's already a cash flow there, it means that we can go and have a conversation, for example, with a banker, because we can demonstrate to them that we're going to have the capacity to repay debt. Um, we can already have the right location, and we know it's the right location because customers are already finding us. And, you know, if I were to compare it with a startup, when you start a brand new business, you have a certain runway of resources and cash, and you have to make the business work before you run out of money, right? And that's the really scary, risky thing, because you're always running toward a cliff. What is the expression? You run towards a cliff as you try to assemble your hang glider, and and if you don't get it built in time, then you go off the cliff and you're done. And that scenario is avoided when we buy an existing business, because we're purchasing a cash flow. And this is one of the reasons why I say that business buyers are a little bit different than most entrepreneurs. I put the investor label on them, because they're examining a business that's operating, and they're looking at that cash flow, and they're thinking, what amount of money does it make sense for me to invest to acquire this operating cash flow? And then the advantages, of course, build upon that when we start to talk about ways that we can improve the business.
Yeah, you touched on bank lending, and I've experienced that firsthand. It's certainly a heck of a lot easier to go get a loan from a bank when you can show that this business has history, and that can make all the difference in the world on getting that loan, is what I've experienced.
Yeah, well, it's real. It's not projections, right?
That's right. That's right. All right. There are some disadvantages, of course. So let's talk about those.
Sure. Well, I love this slide, because a lot of the things on this slide are dangers and disadvantages of business in general. And hopefully some of these things will have forced the business to close before you ever get a chance to try and buy it. So, and in reality, that's what happens when you go out into the world looking for businesses to buy. You will find businesses that are having trouble, and they're not profitable. They don't have sufficient cash flow, and they're not good investments, but people are still trying to sell them, because that's their, their Hail Mary to try to escape from their own situation, is to try to find someone else who's going to come in and buy that. And so you may not have profitability. The current owner might be doing things that enhance what the books look like. Let me give you an example of that. Sometimes a business owner who isn't performing well will cut their own wages or not take a paycheck at all. And then they might post a profit on their P&L statement. But in reality, when we do what's called a normalization of the financial statements, we're going to catch that. And we're going to add an expense for the manager, and we're going to see that the business truly isn't profitable. We also see the same kind of problem when it comes to older businesses that maybe are in real estate that's already owned and paid for. And so normalization is one of the things I teach in my program, that allows us to catch some of these problems before we become the owner.
So my first business back in 1991, I bought an existing franchise. And so I was the guy who didn't know any better, right? And so I bought a business there where the gentleman who owned it, he was desperate to get out of it. He had been trying to get out of it for a number of years, had run it into the ground. We just didn't know what to look for. So it took us, and I've gone back and looked at the numbers. It took us a good 2 solid years to just overcome the poor goodwill that we had, the negative brand that we had in our neighborhood. It was a pizza delivery franchise. And we spent a good 2 years trying to overcome that. I just didn't know to look for that. I thought, well, he was willing to offer seller financing. The price was right.
Mm-hmm.
And my partner and I were desperate to get into business, and we just overlooked those things.
Can I guess what the scenario was?
Sure.
So I don't know what the financial statements looked like, but I'm guessing it was an opportunity like this. Hey, if you were to open one of these today, it would cost you $500,000, and I'm willing to sell it to you for substantially less.
Yeah, I mean, we bought it for, we thought at the time it was a steal. And we did, after 10 years, it ended up being a great opportunity. But the effort that we had to put into those first 2 years, of course, I had to keep my job to keep it afloat. It just, it didn't make a lot of sense. But I just didn't know what to look for at that point.
Yeah, yeah, it's a great story, and I'm glad that you're willing to share that story. A lot of people don't like to talk about things like that, but that leaning upon replacement value as a reason behind the story of why something is a good deal is something that I see quite often from people that are having trouble. It's always about the cash flow, and here's the unfortunate thing: is sometimes people can invest a lot of money in creating a business, hundreds of thousands or even $1 million, and then if the cash flow is never there, what ends up happening is the buyer who comes along to look at it, they're going to price the business based on the cash flow.
Mm-hmm.
That business owner doesn't always realize that he's lost money. I draw the comparison with publicly traded companies. So if you bought shares in the phone company and you paid $100 for them, and then the stock price went down to $50, you would know immediately that you had lost money. That's because there's always that share price available to you online. You just go look and see what the stock market's saying. And the same thing doesn't happen with small businesses. Most small business owners have to wait until they meet that buyer before they actually start to get a market feedback to what their business is really worth. And so it can be a shock sometimes to people who've invested a lot of money to build a business that then find out it's worth so much less because it never performed the way they thought it would back when they were showing the banker those projections when they started the business and borrowed that startup loan.
Yeah, agreed. All right, let's keep moving here. So let's start to talk about some of those things to look for at a high level. We've touched on profitability. That might seem like an obvious one, but like I just shared, I bought a business that was not profitable, and I paid the price for that. What are some of the other things to look for?
Yeah, sure. We're going to get a little bit further into the profitability and cash flow one later on, but not being dependent on the owners. When I talk with business owners, I talk to them a lot about business systems, and the more systematized a business is, the broader the pool of potential buyers. If you were going to go look at a roofing business and the guy who owned the business has been a roofer for 30 years, he knows everything, but it's all in his head. And in the daytime, he runs his crews, and in the nighttime, he goes and does quotes. The only person who's going to be able to successfully run that business is another guy with 20 years experience in roofing, right? If someone can get everything down on paper, here's the tool we use to do the quotations, and this is how we measure, and this is how we input our wholesale price, and this is how we calculate our labor. Once the systems are in place, then other people can come in and learn how to run that business. And so you want to make sure that you are going to be able to run the business, that there isn't a whole pool of secret specialist knowledge within the owner's head. If there is, then he really has to find someone who is exactly like him, just younger, to take over the business. And that middle point there, problems you can fix. The golden goose in this, Henry, is to find a business that has a sufficient profit and cash flow and has problems that you know how to fix.
Yeah, that's the secret, isn't it?
Yeah, because you can buy that business with the problems in place. You can run the business, enjoy the cash flow, and then as you apply your own knowledge to start to address those problems, you can decrease costs or grow the sales, increase the profitability, etc. And now you're starting to do more with the business that you bought.
And those things can be either things that are as a result, for example, as you mentioned, of an owner who's grown, he's burned out, he or she's burned out, they're not paying attention to the details as much. Or it can be, as you've shared with me, examples, real life examples of opportunities that haven't been exploited, right? That business has available, but they just haven't exploited those opportunities for increased revenues or additional product line, additional revenue stream, whatever it might be.
Yeah. One great example I don't think I shared with you before is I helped someone buy a tavern, and the person who was the buyer was an engineer. Before he bought the business, he created this whole scheme for figuring out how he can improve the number of trips the waitress made to the tables. But another thing he noticed when he was doing his due diligence is that the inventory system was far less than perfect. There were multiple people with their hands in the inventory and their hands in the till in the run of a night. So it's very difficult to track slippage, wastage, overpouring, that kind of thing. One of the things he did is he addressed it and he implemented a new inventory system with much tighter controls. And you know what he found, Henry? He found a bartender that had been stealing. And so that bartender was probably walking away with between $10,000 and $15,000 a year in the previous owner's money. And the new owner found it and got rid of the guy.
Yeah.
And all of a sudden, that cash flow of the business went up by $15,000. They didn't have to sell one extra bottle of beer.
Yeah. All right. So finding a business that had problems you can fix. And then I don't think we can overemphasize the not dependent on owners. That might seem obvious, but it's something you have to look for. I can tell you for a fact, the sweet salon business that I sold, the reason I had multiple offers, and I was told this specifically, one of the attractive components of it was that we had developed comprehensive systems to run this place. It was not dependent on me. It wasn't dependent on any one employee. It had very low employee requirements, so that was a positive as well. But we had documented it so someone else could come in, and from day one, I mean, we had a manual for how to run the front desk, how to run the back office, how to manage tenants. Everything was documented, and that was a huge selling point.
And now, if that's missing in a business, here's the other thing that you need to be aware of. If you come from an environment or a background where you're used to creating these kind of SOP documents and workflows and standardizations, if you think that you have the skills to do that, what it means is that when you're negotiating for the business, you want to have a sufficient transition period where you have access to the seller so that you can do your magic and create these things.
That's right. And that's what I did, by the way, because that is something that I'm strong at. And so that's one of the things that we identified that we could quote unquote fix. Yeah.
Yeah.
All right.
Yeah.
Let's talk about criteria, because to me, this is so important. I think this is another area where people make big mistakes. They go and buy a business that's not aligned with what they really want now and into the future.
Yeah. Well, I think I mentioned this on the podcast. When you're buying a business, you are both an investor and a job seeker to a good degree, because most of the time, even if you have a plan to put a manager in place eventually, initially, you're probably going to have to be in there with your sleeves rolled up doing work. So it's got to be something that you're going to find interesting, because otherwise you're not going to want to go there. And you're going to end up in the position of the person who's bored looking for a new challenge far too soon. And so there has to be some kind of alignment between your interests and skills, I usually say to people. So if you don't like to serve consumers or homeowners, et cetera, then maybe you want to lean towards that business to business where you're going to be serving other business owners, for example. Some people really like to have a lot of tangible assets in their business. It kind of creates a plan B. If things don't go well, I can sell equipment or something. Other people are more than comfortable with a service business that has very little in the way of tangible assets, or even a business that's driven by intellectual property. So software, some kind of formula, or some kind of special way of solving a problem for people. And so when I work with people, we go through this sort of checklist, this internal examination of what kinds of things you've done in your past that you've enjoyed and what you haven't, what your interests are. And then we create a list of criteria, not necessarily a list of business types. And here's why. When you create a list of criteria, you could be describing businesses that you don't know. And so with a list of criteria, you can then go to a list of business types and start to ask yourself, does this type of business meet these criteria? Does this type of business? And what almost always happens is people end up discovering businesses and industries that they never knew about that actually, in fact, meet their criteria, which means that there's all new areas of opportunity that people can explore if they know what characteristics they're looking for in the business that they want to buy.
Yeah, agreed. And then, we put sales on here because I think that there's so many businesses that, while we might not think of it as in a traditional sales way, require us as the owner, at least initially, to get out there and get the business. That's one of the mistakes I often see is people think, well, I'll buy it and people will come to me. Well, you've picked the wrong business then, because a lot of businesses require you to go out there and get the business, at least initially. So you have to ask yourself, is that something that I'm willing to do? Am I comfortable doing that? Can I do that?
Well, one of the things that I often say to people is that their most valuable resource as a business buyer is actually their time. Because when you start to look, there's a lot of stuff to look at, and a lot of it may not be a good opportunity. And so in the course that we're going to talk about later, I teach certain rules of thumb about cash flows to owners based on the top line revenue. And so if you know you need a certain kind of cash flow in your pocket, it can mean that there's certain minimum revenue levels that you can look at as far as a business. And so someone could come to you with an opportunity in an industry that you like, and the first question should be, what are the sales? What's the revenue? And if it's not the number you need, then you can know that in all likelihood, the net result of that business is not going to be enough money for your pocket.
Another example of applying the criteria is, for me personally, where I am at in my life now, I look for businesses either to invest in or to start that if they're going to be physical, brick and mortars, then it has to be a manager model. I want to be able to enjoy now location freedom. So that's important to me at this point in my life. So of course, I'm going to look for businesses now that are either virtual or that are manager managed, instead of me having to be the one working in the business at any length of time on a daily basis.
Mm-hmm. Yeah, that's a great point.
All right, let's keep moving. Your team, because this is another thing that I think people, either because we're trying to cut corners from a financial perspective, which I get it, but also not understanding who all needs to come into play here at different points in the process.
Yeah. So I'm going to give you, and Henry, I know you know the answer to this question. How do you know if somebody works for you?
How do I know if somebody works for me? I don't know. That's a tricky question. I don't know.
It's not a trick question. You know this. What do you have to give to someone that works for you?
Oh, I got to give them some money, right?
You pay them, right? So,
Yes.
So the easiest way to know if somebody works for you or not is if you pay them money.
Okay.
Right. And so the reason why I asked that question is because there's people on here that you don't pay money to, right? And that would be number one, is the business broker. And in almost every scenario, the business broker is someone engaged by the seller who is paid by the seller upon the sale of the business. Now, in many jurisdictions, in many places, many states and provinces, that business broker could be in a position of fiduciary duty to both the buyer and the seller, right? And a lot of these people really do a great job of being honest and forthright and helpful to the buyer and the seller. I know when I was a business broker, I tried to be helpful to the buyers because I knew that if there was something wrong with the business for them, that they wouldn't complete the deal and I would end up wasting all my time. So I tried to make sure that there was a good fit. But there are other people out there who need to make a car payment. And I've seen more than one example of people who have been told stuff by a broker to try to get a deal closed. And so this is why I always make this caution to people, is that the business broker is paid when you buy the business. And so their interest in interacting with you is to make sure you buy that business that they have for sale. It may not be to advise you that this isn't the right business for you, or that maybe you would be better off as an employee, right? It's almost like going to a real estate agent asking where you should live. They're probably not going to recommend an apartment, right? Yeah, and so if we look at the rest of this list, you know, the business coach that you work with who is going to be with you through this transaction, they're definitely working for you, right? And they want you to be successful because they want to carry on that coaching relationship into your career of ownership with the business. The attorney, you know, you're going to pay him. And what I like specifically about certain advisors is you're going to pay them whether you're successful or not, right? So that attorney doesn't have to worry if he gives you advice or points out a hazard that he's not going to get paid, because he's still going to get paid even if you don't buy the business. And that's going to give him every incentive possible just to do his job, which is to warn, advise, help you with documents, etc. Same thing with the CPA. The lender is going to earn money off of you as you repay that loan through interest payments. And here's the caution I'll share about lenders, is if you deal with a bank who holds the notes, the last thing they want to do is foreclose on someone or have to come after you in some way, treat you in the special loan department. A lender who sells the notes may not have the same motivations. Okay. And what I love about lenders is, as a buyer, if you bring a deal to a lender, an experienced lender will tell you why it's not a good deal and why it ultimately won't work for you. And that is a great indication as a buyer that you found something that may not be as good a deal as you think. Then you have your commercial insurance agents. Appraisers and technicians come into the due diligence process. So sometimes you've got machinery, equipment, real estate. You want an appraiser to come and tell you what it's worth. And if the business is capital intensive, if there's big machinery, then you're probably going to want the advice of a technician, someone who services that kind of equipment, to come in and take a look and tell you about things that may have to be serviced or replaced in a short period of time. We buy cash flows when we buy a business. And so if somebody knows that they're going to be selling their business, one of the things they may be tempted to do is to defer maintenance so it looks like their profits are growing. I break it down on my website, businessbuyeradvantage.com, into 5 steps that I work with people through. And then there's a couple of further steps that they're working with other local specialists with. So education, appearing on podcasts, appearing on things like this webinar, the 400 YouTube videos I put out, the books that I've written, most of which are $10, that's the education component. And most of it can be had for almost nothing. If somebody goes through a bunch of my stuff and they say, yeah, this is what I want to do. I want to be in business. I don't want the risk of a startup. I want to buy something that's already profitable. Then the next step is the training. And that is the course that I do. It started off a decade ago as a full day seminar, about 10 hours in a classroom with people with workbooks and everything. And it eventually migrated into an online program. We're going to be talking about that one later on today. And so that training program, people have taken that training program and a couple of different outcomes have occurred. Some people have taken it, said, you know what, now that I know what I know, I don't think this is for me. And other people have taken that training and they've gone, they bought businesses, in some cases, multiple businesses. And then they email me afterwards and thank me and say, look, here I am. Sometimes they send me photos of them standing in front of their businesses. So that's the training component. Preparation and coaching is when people want to work with me more. And I've got one-on-one and I've got group training programs, coaching programs that I work with people who are all focused on the same goal, which is finding and acquiring a business. And then I do analysis and guidance for people. So actually just today, I had a client, they're looking at buying an auto repair business. So they sent in the financial statements. We reviewed them together. That's kind of the one-on-one consulting that I do. The capital, I'll advise people on what kind of lending they should be able to do based on their circumstance and the business at hand. But they're going to have to find a local partner who's going to complete that with them, either the loan officer at the bank or some kind of loan broker. And then, of course, the paperwork's got to be done by a local attorney, and the due diligence is going to require a local CPA to give you help with that. And then the transition is something that I'll coach people through, but really it is the person who's buying working with that seller. And what we often do is we plot out the pathways or the systems in the business. I like to look at where things come in and where things go out of a business and create sort of a pathway, and that creates a roadmap for someone to understand how a business works.
And we didn't focus on it too much when we were talking about the advantages. We may have mentioned it briefly, but seller financing, I just want to go back to that because as we relate to capital, my experience, the businesses that I've bought now, several businesses that I've bought, I have always taken advantage of seller financing. And to me, it's worth mentioning again, because to me, that's one of the huge advantages of buying an existing business, is if that seller will extend you a note.
Well, and not only is it an advantage, I actually say it's a necessity. There are so many advantages for a buyer to have a seller note, and especially if the seller note is done correctly. And by correctly, what I mean is subject to offsets in the case of an undisclosed or undeclared liability or a material misrepresentation. Material misrepresentation is a legal term, and it means that somebody knew something that was going to have a real material impact or fallout for the new owner, and they either failed to share it or they hid the detail in some way. And so if you have that clause in place, what it basically means is that you have the ability to end up paying less for the business if it turns out you didn't get the business you were promised.
Mm-hmm.
Almost kind of like a warranty.
Right.
And it's so critically important. In fact, sometimes lenders will require it, or they'll require a certain degree of it, because for the lender, imagine a banker in his position is trying to figure out if he should make a loan for you to buy a business, and the person who knows the business better than anyone else is the seller. And so if the seller is willing to finance part of the transaction, what it tells the banker is that, number one, the seller believes that the buyer is capable of running the business, which is one of the banker's first questions. Number two, the seller believes that not only will the buyer be able to satisfy the bank note, but he'll be able to satisfy the seller note, right? Which is another huge thing. And number three, and this is, one that I talk more about with sellers, but if there is a seller note, it means that the bank's got more options if the buyer does happen to have trouble. So this is a basic formula. And I'm going to explain these components. So seller's discretionary earnings is the total cash flow available to an owner manager that works full-time in a business. So this is the business's profit and the manager's wages combined. And small businesses that have earnings under about $500,000 are usually sold as a multiple of this seller's discretionary cash flow or seller's discretionary earnings. There's a couple of different terms. They mean the same thing. And every industry has a different risk profile. So a restaurant is riskier than a septic pumping business, for example. And so when you work with a professional, they're able to access databases of past sale transactions, and they can see what other people paid for businesses as a multiple of that cash flow. So in the case of a restaurant, let's say that multiple is 1.7. So that $100,000, let's say, of seller's discretionary earnings times the 1.7 is going to give a $170,000 value. But what is that value? It's called an enterprise value. And if you flip the slide, Henry, I want to warn everyone that a big mistake that a lot of buyers make is that they will not understand what that value really means. That enterprise value is the value of the cash flow. And when you pay that amount of money to acquire the business, you need to get everything required to run the business. So what that means is, because this is based on the idea of a going concern. And most of the time when we're buying a small business, we're not buying the shares of an entity. We're doing an asset transaction where we're just taking inventory, equipment, etc. And so what happens when we do an asset transaction is the operating capital components are often removed from the deal. So the seller keeps his receivables in cash typically, and he'll pay off his liabilities. Now, in a normal business, if we have inventory that is what we call fungible, that can be financed. So think 2x4s in a lumber yard, not ladies' dresses or fresh fruit. Okay. So if the inventory is fungible, it can be financed, normally around 75%. Receivables sometimes can be financed up to 80%. And sometimes we can get part of our operating capital by owing money to our suppliers. So in the normal course of business, there should be some borrowing that a business can do from the suppliers and from the bank. And it usually doesn't cover the entire requirement for operating capital, cash, inventory, etc. There usually is some component of the owner's own money that has to go in. And we call this the normal net position in working capital. And that enterprise value includes it. So here's the problem, Henry, that people run into is they'll figure out what a business is worth. They'll get that enterprise value, and then they'll do an asset transaction, and they will then, after they pay the seller, have to put in that net normal position in working capital of their own cash into their own business. And in that moment, they just overpaid for the business.
Right. Because they didn't bring that into the calculation. Yeah.
Right. So
the other thing that's not brought in is, of course, if there's a salary there that's being paid to the owner who's managing the business, factoring that in as well, right?
Well, that would be factored into the seller's discretionary earnings because remember, that figure is a total amount of cash flow available to an owner operator. So So if the seller's paying himself a salary and having a profit, we add those two together.
Mm-hmm.
And investigating how the owner's taking money out of the business is part of our normalization process, and adjusting it too. Because like I said before, sometimes you've got an owner who's doing, a full-time, more than full-time job. He's working 60 hours a week and he's only taking $25,000 a year because that's all the business can afford. When we do our normalization, we're going to say, how much would someone have to pay a manager to work those 60 hours a week in this industry? And it's probably more than that 25 grand. And so we make that adjustment. So the other big area where I find that people make mistakes is in the cash flow. So that seller's discretionary earnings, that cash flow that you're acquiring when you buy the business, it needs to cover several things. Number one, if you're going to be in there doing the job of the manager, you've got to take home a paycheck for yourself. And don't forget, you need to pay income taxes on the profits. And this is where you're going to have to talk with your CPA, because it's going to depend on which state you're in and how you're organized. So for example, if you are a C Corp or an S Corp or an LLC, there's going to be different implications. Sometimes the corporation pays income tax on its earnings after you've taken your salary. In other situations, you personally are going to pay taxes on the entire profitability of the enterprise, depending on how you're organized. So you can't forget about income taxes. You got to take home pay. You then also have to service the debt that you take on to buy the business. And here's one that people always forget, Henry. They have to get a return on the cash they put in. So if you put $100,000 of your savings down, you need to make sure you get an adequate rate of return on that money that you put into the business. Two more things that people always forget about. Number one is CapEx. That seller's discretionary earnings number, we usually do not include amortization and depreciation. Those are the tools that accountants use to recognize the fact that things wear out over time. So this, leads to that deferred maintenance concept again. So if I have a business that has pieces of equipment or vehicles that are wearing out, I need to know that I've got a cash reserve that I can build up, or a cash flow that I can use, for example, to lease a new delivery van, right? So we need to include something for capital expenditures. And if we're going to grow the business, remember that normal position in working capital, it's probably going to have to grow too. And so that's the change in working capital adjustment. And so people will get very excited. They'll see a seller's discretionary earnings of 130 grand and they'll say, yeah, I'd love to have an income of 130 grand. But when we start to take all of these things out of it, pretty soon that income starts to fall. And of course, one of the problems is that if they're too aggressive with their debt repayment can eat up the cash flow. So even if you pay the right amount of money for the business, if you try to pay for it too aggressively, you can end up without enough money to feed your kids.
So a couple of rules of thumb from my experience, having bought businesses before, and David then has shared his, can add on here. But when I look at a multiple, in my experience and what I've done is, like David said, businesses that are under 500,000 in earnings or so, I see those businesses selling anywhere from a 1 to a 3 multiple. Anything above a 3, for me personally, this is Henry Lopez's opinion, it's got to be an exceptional business. There's got to be a lot of reasons why. And every business is different, right? But in that price range for typical businesses, that's what I look for as realistic. Anything to add to that, David?
Well, I think that just reinforces the very beginning of the session here today, because I said that people don't get excited when they learn what their business is going to sell for. And that's why there has to be a personal need to move on and sell the business. Because I'll tell you what most of these business owners will say once they hear what their business is going to sell for. They say, well, if I just stayed around for a couple more years, I'd have the same money.
Right.
Which is absolutely true, right? So there's got to be some other thing that's pushing them toward the door.
The other thing for me, there's a rule of thumb that I always share with my clients that I look at, that return on cash. I annualize that. So how long will it take me to get back in what I take home to recoup my cash investment? And I like to see it anywhere between 3 to 5 years. That's my rule of thumb. What are your thoughts on that?
Yeah, the overall average for all businesses, and please don't use this as a rule of thumb in your own deals because it's just an average, is that small businesses sell for about 2.2 times their cash flow. And if you reverse that using the math you've forgotten from grade 9, it works out to about 40%. Mm-hmm. So it's, you're right in the ballpark. It depends on the type of business. The program that I mentioned before, Business Buyer Advantage, which was the full day session, it normally retails for $359 and people buy it all the time. And I've been selling it now as an online course for years. Hundreds of people have gone through it, and many people have, decided to move forward and buy a business using the information in the package. I don't ever do discounts or sales. So this is kind of a special thing that you guys have been able to access through Henry's help and insistence with me. But we've bundled a few things together here, and we're happy to offer this special deal. So there's the Business Buyer Advantage online program, which sells for $359. I've got a special report called How to Borrow Money from Your Business Broker. And it's a really innovative financing technique that you can use if you have some small gap in the amount of money you're able to raise to buy a business. You can often leverage the broker's commission. So we've included that. Back almost a year ago, actually, a year ago in a few weeks, in 2018 on Black Friday in Toronto, I did a live session. It was an abridged version of Business Buyer Advantage. It was about 3 hours with a live audience. And so I made a recording of that. So it's a lot of the information that's in Business Buyer Advantage, but you get to take advantage of the live Q&A that happens throughout the course of the day. So I've included that recording as well. And another program that I run, which is called Build a Business That People Will Want to Buy. It's all about implementing those small business systems that are going to make a business work well and work better and be more valuable, etc. It normally sells for $250. And anyone who takes advantage of this package today is going to be able to buy that program if they choose at half price, and there's no time limit on that. So we bundled this all together. The normal value of all those things is $672, and you can have it today for $399.
Let's summarize what we've covered in this webinar. First and foremost, we believe you have to start with your criteria. You have to define what your why is, where you're going, and then that'll help you identify the right kind of business that fits you now, but also that helps you get onto the path of where you're going. A business has to help you get to where you're going, what future it is that you want for yourself and for your family. You got to start by getting educated. Obviously, you attended this webinar, so you understand that. You have to read, you have to attend webinars. There's lots of free content on David Barnett's website, for example. So educate yourself and then get the help that you need. Whether it's somebody like Dave or myself as a coach, a broker, you'll definitely have to engage an attorney and a CPA at some point in the process. So be sure to get the help that you need. Then do your research, do the analysis, and then most importantly, do the due diligence on the business that you have selected before you close on that transaction. Be sure to do the due diligence. Look at the numbers, analyze the numbers, make sure you calculate that enterprise value. Make sure that you include things like your working capital that you're going to need and whatever salary you need to pay yourself if you will be working in the business. The numbers have to make sense. And I know that's a simple statement, but be sure not to just fall in love with the business and not look in a very detailed manner at the numbers. And this is, again, where you should get help from a coach like David, from a CPA. Look at the numbers. Even if that's not your strong suit, get help in that area. Thanks again for joining us for this webinar on buying a small business. This is Henry Lopez, and on behalf of myself and my co-host David C. Barnett, we thank you for joining us, for making the time to be with us on this webinar. Feel free to share it with others you might know who could benefit. And of course, you'll find other links and information on this site, as well as you can always visit thehowofbusiness.com or davidcbarnett.com for more information.